Hey folks, Larry Berman here, and here's what's on my radar this week. Well, just about everything that's red is on is on the radar this week. Um, we've talked about the Jackson Hole speech for a couple of weeks now, and the importance of the Fed clamping down on inflation expectations, and that was going to be the feature of the speech. Apparently, the shortest Jackson Hole comments by the Fed chairman in history. Very succinct, very to the point. We're not letting inflation get out of control. It means higher for longer. So let's have a look at some of the screens this week and see where all the opportunities lie. I remember back in the day where 1,000 Dow points was a lot. It's still a lot, but you can see the red across the screens. If you look at market breadth, the advanced decline line column here, you can see pretty clearly at the S&P 500 level, we had far more than a 90% down day. It was a 99% down day. For the broader NASDAQ, it wasn't. You actually had more than 10% of stocks up. So that's interesting. We'll take a little more investigation on our part to see what's kind of going on under there. But definitely for the broad large cap S&P, where we've been warning, careful, especially on the tech names, down closer to 4% today. So that was a real confirmation of our concern regarding what the Fed needs to do here, and that the market rally was to be rented. So, pretty good call there. As Jackson Hole speech came out and the headlines hit, market peeled off pretty quickly. He said something right around here that was, but maybe we pause at some point, or slow the pace down at some point. Markets rally back to the highs, but make no mistake, we're going to take the punch bowl away. And then really the rest of the day is pretty clear, what's happened there. So most important takeaway for the day, short-term and long-term inflation expectations. What happened on the short-term inflation expectations? The 2-year inflation swap hung in and actually came down on the day. That, folks, is a 2 thumbs up. And the reason that's a 2 thumbs up is because that's the Fed's goal. So is this going to absolutely crater the economy? That's not their target here. Their target is to get inflation down below 3% and ideally a bit closer to 2 before they start to ease again. To me, that could take at least a year, if not closer to 2. Now, that's the debate going forward. How long does it take? Long-term inflation expectations, the 5-year swap, ticked up 1 basis point today, but still well contained. So good news from that perspective, bad news short-term for asset markets. As long as long-term inflation expectations remain contained, that we should get a retest of the lows that we saw this summer, but possibly those were the lows and we don't break them. I still have a strong case to be made for 3,200 based on valuation, based on what will happen with earnings through the next 2 or 3 quarters and earnings expectations. But that's kind of down the road, not, the next month or 2. QT is starting to accelerate in September and October and beyond, and that should stress interest rates, which we saw in part of the curve today, and that should ultimately impact asset markets. So in terms of, where do you go? What do? You look for your favorite dividend payers. ZWH is the BMO high dividend covered call ETF. And when you look at what's in it and the good quality dividend payers that BMO looks for in this ETF. This is your shopping list if you're a dividend focused investor. And you can go into the ETF itself, maybe not Monday, but but this is where you start to look. So this is my list for some more defensive holdings where I'm looking to write puts or snap up some positions. Today on McDonald's, I bought ratio put spreads, so I want to own McDonald's. I want to buy it lower. We were buying ratio put spreads on McDonald's. That was one name we were active in today. We wrote, well, the other day we bought ratio put spreads in Home Depot, again, another good dividend pair. I've got no exposure right now in Caterpillar. That's a name that's coming onto my radar as well. As the global economy weakens, demand for their products, but still it's something that you generally want to buy on weakness. There isn't going to be a stock that you generally want to chase on strength for the better part of the next year. What do we look to avoid, or where you're looking for shorts? Continue to think the NASDAQ will, at a minimum, retest recent lows, and I suspect a high probability of undercutting them. And so what do you look to avoid? Some of these names, some of the more defensive names in the NASDAQ, and there are a few. Dollar Tree would be one of them, except it's a much higher multiple stock than you would think for a discount chain, if you will. So anyways, that's it for the week, folks. Have a good week. Caution is still the main message here, and there'll be a lot more opportunity for those of you sitting with some cash in the next couple of months. Have a good one.